Welcome to the Explainer. Today, we are completely bypassing the media hype and that endless speculation surrounding artificial intelligence. Instead, we're going to mathematically reverse engineer today's top AI ETFs. We're getting right into the hood, using their exact figures, their specific growth percentages, and a ruthless valuation filter to pull out the absolute best individual stocks you can buy right now. We're going to rely strictly on the math to show you exactly how to evaluate these massive moves so you aren't just blindly chasing returns. Let's get right into it.
Okay, here's our roadmap for today. We'll start with exploding AI demand, then reverse engineer memory, filter chips, and power. Build the pure play portfolio, look at a crucial earnings calendar, and finally, tackle market reality and hedging.
Part 1, Exploding AI Demand.
Now, to really understand why funds like the DRAM Memory ETF are up 99% in just 6 weeks, you have to look at the sheer hard data. Leading AI model maker Anthropic, they reported an increase in compute demand of 8,000% in just the first 3 months of this year. I mean, let that sink in for a second. That's not an 80% increase. We're talking an 8,000% spike in compute demand in a single quarter. Absolutely wild. And that insane demand, it's forcing a $1 trillion a year build out of AI data centers. Right now, 57% of companies already have an AI agent in production, and 1 in 4 large companies are spending over $5 million annually just to develop them. But the real heavyweights, the hyperscalers, so Alphabet, Meta, Microsoft, and Amazon, they are deploying a staggering $725 billion on AI this year alone. They're growing their spending by 35 to 60% annually, which means all that hardware and memory they require is becoming a massive, incredible bottleneck. All right, moving to part 2, reverse engineering memory.
So the crucial point for us is this formula right here. You know, if you just look at a stock that has run up triple digits, it's so easy to get sticker shock. We strip all of that away by calculating what we call the adjusted valuation. We simply take a company's seemingly expensive price-to-sales ratio and divide it by its expected revenue growth rate. Doing this reveals its true relative value. It shows us exactly what we're actually paying for that growth, stripped of all the noise. And when we actually run the math on the 4 US-traded stocks in the DRAM fund, the winner is super clear. Just like at SanDisk, it trades at a pretty high 15.3 times sales, but because it has a massive 112% expected growth rate, its adjusted valuation drops down to an incredibly cheap 0.14. And get this, that is true even after SanDisk posted a 3,200% historical return over the last year. Micron is also looking like a great deal at 0.17. Meanwhile, Western Digital is trailing at a distant 1.35, mostly because its meager 10% expected growth simply doesn't justify its premium. So sorry Western Digital, but SanDisk takes the crown in the memory race.
Which brings us to part 3, filtering chips and power. Now, applying our strict filter to generalized funds like the Wedbush AI ETFs, we toss out the legacy players like Intel and compare the absolute giants who are expecting massive 43 to 55% revenue growth. And wow, the race is incredibly close. Adjusting for that massive growth, AMD comes in an adjusted valuation of 0.46, and Nvidia is just a hair higher at 0.48. On the surface, these two look like a virtual tie for your investment dollar. But this data right here brilliantly illustrates the tiebreaker. Just take a look at these margins. Nvidia's EBITDA margin, which is basically its core cash operating profit, is a massive 61%, while AMD's sits at just 20%. What does that mean? It means Nvidia is converting its growth into actual earnings at 3 times the rate of AMD. So for a nearly identical adjusted valuation, Nvidia offers a dramatically more profitable business. It is the clear fundamental winner for our chips. Running that exact same filter on the power and infrastructure sector, we see Quanta Services emerge as the absolute best relative deal at a 0.21 adjusted valuation. It easily beats out Bloom Energy. Because look, even though Bloom boasts 61% expected growth for data center power, its sky-high 31.4 price-to-sales ratio gives it a really expensive 0.51 adjusted valuation premium. Quanta just gives us the best risk-reward math here, hands down. Okay, part 4, the pure play portfolio. So putting it all together, here is your definitive data-driven pure play portfolio. We're taking SanDisk for memory with its incredible 0.14 adjusted valuation. We're grabbing Nvidia for chips to capitalize on that massive 61% margin. We lock in Quanta Services for infrastructure at a 0.21 adjusted valuation. And finally, we're actually going to retain a holding in the original DRM ETF, not for the US stocks, but to guarantee we keep exposure to crucial foreign memory giants like Samsung and SK Hynix that we just can't easily buy on US exchanges.
This isn't guesswork, guys. This is exactly what a mathematically optimized, data-driven portfolio looks like in the real world. Moving on to part 5, crucial earnings calendar. Now that we have our perfectly optimized portfolio, it is going to face an immediate test this Wednesday. In the morning, we have Home Depot targeting just 4% sales growth. Now, that's a stock that's already down 11% this year, so we're going to see if a discount of 22 times earnings prices in the bad news. Midday, Walmart gives us the ultimate consumer health read, targeting 6.5% growth while actively using discounted gas to drive store foot traffic. And then, Wednesday afternoon, the main event, Nvidia. They're targeting an immense $371 billion in full-year revenue, which represents an unbelievable 72% growth. For Nvidia specifically, the setup is super fascinating. The US just approved sales of their H200 chips to 10 Chinese companies. This could allow CEO Jensen Huang to upgrade next quarter's $87 billion forecast. But here's where the math shows a historical risk. Despite beating earnings forecasts by an average of 5% over the past 4 quarters, Nvidia stock actually fell on 3 of those 4 earnings days. Yeah, because Wall Street is nearly impossible to please. So as smart investors, you should be totally prepared to buy any immediate dip.
And finally, part 6, market reality and hedging. With the S&P 500 trading at 22 times forward earnings, we have to ask, does it need absolute perfect news to sustain its recent momentum? I mean, the market has jumped 18% in just 6 weeks, and companies are boasting a 27% earnings growth streak. But investors are currently ignoring some very real risks to get there. We're looking at really sticky supply chain inflation, highlighted by a 6% jump in wholesale prices last month. Plus, the blockade in the Strait of Hormuz has essentially frozen 20% of the global oil supply. Make no mistake, these headwinds are going to command attention sooner rather than later.
So let's move to our final strategy and see how we can build a highly efficient safety net. We're going to execute a put spread on the S&P 500 ETF. This is essentially buying an insurance policy and then selling a cheaper one to offset your cost. Step 1. We buy the $745 put expiring June 18th for $12.25. Step 2. We simultaneously sell the $740 put for $10.45. What that means is our total spread cost is just $1.80 per share to strictly limit our downside. The math on this hedge is just incredible. If the broader market drops just 1% over the next 5 weeks, that $1.80 spread maximizes to its full value of $5. That yields a massive 177% return on your hedge, and that provides immediate cash to cushion any choppy losses across the rest of your broader portfolio. Pretty smart, right? Which leaves us with this final thought. If the broader market is up 18% in 6 weeks and currently demands absolute perfection to keep climbing, is your portfolio's math strong enough to handle a reality check? I really challenge you to take these adjusted valuation metrics we went over today and apply them to your own holdings. Strip away the hype, run those percentages, and ensure you're managing your risk before the market decides to do it for you. Thanks for